You've probably heard the phrase, don't be the bank. But what if I told you that being the bank the right way can be one of the smartest, safest, and most profitable things you ever do with the property you already own? I'm talking about owner financing, where you, the homeowner, become the bank, and buyers line up to pay you instead of Wells Fargo or Bank of America. And here's the part that banks really don't love. In a lot of situations, owner financing can mean a higher sales price, monthly income for years, and potential tax advantages, while still being secured by the property the whole time. If that sounds interesting, stick with me. By the end of the video, you'll know exactly how it works, who's it good for, and who it's not for, and how to protect yourself so this becomes a win-win instead of a headache. And hey, real quick, before we dive in, if this kind of real estate talk is helpful, tap the like button, hit subscribe, and turn on the bell. It helps more homeowners find this info, and it tells me to keep making these videos like this.
With the stars and stripes and the eagle flies.
If we haven't met, my name is Fred Pascal, and for the last 20 years, I've bought, sold, built, flipped, and done just about everything when it comes to real estate. I say that so you can have the comfort of knowing that anything I share with you is from tried and true decades of boots on the ground experience. You won't get this in any textbook. Okay, so let's break this down in plain English. Let's start simple. Owner financing means instead of a bank lending money to a buyer, you, the homeowner, allow the buyer to pay you over time. The buyer gives you a down payment, makes a monthly payment, principal plus interest, and the whole thing is secured by the property itself. Now there's still a promissory note, there's still a deed of trust or mortgage, it's still recorded, it's all legal. You're not doing it on the back of a napkin, you're just replacing the bank with you. Okay, here's a simple example. You own a property worth $200,000 free and clear. A buyer comes to you. You agree on a sales price of $210,000 because you're offering financing. The buyer puts 10% down, or $21,000. You finance the remaining $189,000 at, say, 7% interest, amortized over 30 years, maybe with a 5 or 10-year balloon. Now that monthly payment goes to you, not the bank. Now stay with me, because here's where it gets powerful for you as the seller. If you're an older homeowner or a landlord who's tired of dealing with tenants, you might be thinking, Fred, why would I finance a buyer? Why not just take my money and walk away? Totally fair question. Here's some real reasons sellers choose owner financing though. You can often sell faster. There's a huge pool of buyers who are self-employed or have some credit dings or just changed jobs, went through a divorce, or have great income but don't look perfect on paper. The banks say no to those people all day long. You can say yes if the numbers make sense. You can often get a higher price. When you're offering terms, just like car dealerships do, you're offering something banks can't: flexibility. Buyers will frequently pay a little more for the property in exchange for fair monthly payments and less red tape. You turn a lump sum into a consistent paycheck. Instead of selling for, say, $200,000 and sticking it in a savings account at 3%, you might finance at 7%, 8%, or more, secured by an asset you already understand and own. Potential tax advantages. Talk to your CPA about this. But in many cases, an installment sale lets you spread out capital gains over time instead of paying a big tax hit all at once. You know the collateral, you already know the property, you know the neighborhood. You're not guessing where your money is going. Your money is literally sitting in the house, and the buyer is paying you to use it. If any of that sounds appealing, please do me a favor, hit the like button so this reaches more people who need to hear it. Now, I promised I'd talk to both sides a bit because that's part of what makes this topic go viral. Buyers love the idea of skipping the bank. So if you're a buyer watching this, drop a comment below and tell me your situation. Are you self-employed? Just changed jobs, poor credit issues? I read the comments. Typical owner finance buyers look like this. They're self-employed. They write off a lot of taxes. They have a short job history in their current position maybe. Solid income, but a credit score in 500s or maybe the low 600s. There's a recent life event maybe, divorce, medical bills, relocation, etc. Banks look at them and say, sorry, no. But to a seller, especially one with a paid off property, if that buyer has 10 to 20% down, a solid income, and is willing to pay a fair interest rate, that can be a great opportunity. One of the reasons banks are comfortable lending is skin in the game. For most owner finance deals I've seen go well, there's usually at least 10% down. sometimes 15% or 20%. So using our earlier example, $200,000 property, 10% down, which is $20,000. Buyer finances $180,000. Why is that down payment important for you as the seller? It weeds out non-serious buyers. The buyer is highly motivated to protect that equity, that down payment. If they don't pay, you have legal remedies, foreclosure, for example, and they risk losing that down payment and any principal they've paid in. Now, an important point, if you're thinking about owner financing and the buyer doesn't have a meaningful down payment, that's a yellow flag. Write this down. No down payment, no deal. This is the number one question I get from sellers though. Fred, what happens if they just stop paying me? Great question. Here's the short version, and of course, always consult your own attorney in your state. The loan is secured by a deed of trust or mortgage, just like a bank uses. If the buyer stops paying, you don't just shrug and say, oh well, you have the right to foreclose. Take the property back, resell it. Is foreclosure fun? No. Is it fast? Not always. But here's the key. If you structured the deal correctly, you've already collected a strong down payment. The buyer has made monthly payments, interest to you. You've had income the whole time, and if worst case, you take the property back, you can either resell it or rent it. This is why I always recommend to use a real estate attorney who understands owner finance, use a loan servicing company to collect payments, escrow taxes and insurance, and keep the records clean, and screen your buyer. Income, stability, references, etc. You may not be a bank, but you don't want to be reckless either. Let's talk about how the numbers typically look. As a seller, you can structure terms like interest rate, often 1 to 2.5% higher than conventional bank rates, because you're offering flexibility and less red tape. Amortization, frequently 20 to 30 years to keep the payment comfortable for the buyer. Balloon payment. Many owner finance notes have a 3 to 10 year, 15-year balloon payment. What's a balloon? The monthly payment is calculated as if the buyer will pay you for 30 years, but the remaining balance is due in, say, 5 years, 10 years, 15 years. That forces the buyer to either refinance with a bank down the road or sell the property and pay you off. From your perspective as the seller, that can be great because you get years of interest income. Then you get a lump sum later. All the while, the buyer maintains the property and pays the taxes and insurance. Let me give you some real life seller situations where owner finance can make a lot of sense. Tired landlord. You've had it with tenants, toilets, and turnover. Instead of just selling the rental and paying a big tax bill, you sell with owner financing. No more midnight calls, no more vacancy stress, just one tenant paying you like it's a mortgage. Maybe you're an older homeowner with a paid off house, but low monthly income. On paper, you're asset rich, but your monthly cash flow doesn't really feel that way. Selling with owner financing turns that equity into a steady paycheck every month while still being secured by the property. Maybe it's an inherited property. Maybe you inherited a home you don't really want to manage, but you don't love the idea of cashing out and blowing it all or paying big taxes all at once. Owner financing can stretch that out and create a long-term income stream from something you didn't even buy yourself. If you see yourself in any of those, drop a comment below and just say, hey, that's me, or tell me your situation. I genuinely read those and it helps me make better videos. Now, I can't give you legal advice. This is just general education. But here are a few things I strongly recommend you do not skip. 1. Close with the real estate attorney or title company. This is not a kitchen table handshake kind of deal. You want a promissory note, a deed of trust or mortgage, everything recorded correctly. Get a title search and ideally a title policy. You want to be sure you own the property cleanly and that the buyer is getting clean title subject to your note. This protects both of you from old liens, unpaid contractors, surprise taxes, etc. Use escrow for taxes and insurance, just like the bank does. Have the servicing company collect a monthly amount for taxes and insurance so you're not depending on the buyer to remember to pay those once a year. Understand the due on sale clause if you still have a mortgage. Everything we've talked about today is easiest when your property is owned free and clear. If you still owe to a bank, there are ways to structure deals, but that's getting into something called subject to territory or wraps. And you absolutely need a pro on your side for that. If you're a buyer watching this thinking, Fred, where do I find these owner finance deals? The short answer is some are listed on the MLS as owner finance available. Some are marketed by investors like me. Some are just quiet deals between a seller and a buyer who knows how to ask. Here's the thing though, buyers, if this type of content helps you, hit the like button, subscribe, and let me know in the comments if you want a separate video just for how buyers can find owner finance deals without overpaying or getting burned. Okay, back to my sellers. Let's zoom out. Every time a seller finances a buyer directly, that's one less loan file for a bank. That's one less origination fee. That's one less loan they can bundle into a mortgage-backed security. In other words, the more people learn how to work together, buyer and seller, to create financing without a bank in the middle, the less control the big institutions have. Now, am I saying banks are evil and nobody should ever use them? No, of course not. I use banks too. But I am saying this, if you own a home with a lot of equity, or especially if it's paid off and you've never at least looked into owner financing, you might be leaving a lot of opportunity on the table. So quick recap, owner financing lets you become the bank. You can often sell faster at a higher price. Turn your equity into a steady income stream. It's especially powerful for retirees, tired landlords, and owners of inherited properties. There are risks, but with the right down payment, the right paperwork, and the right pros helping you, it can be a very smart move. If you're in the Houston area and you're sitting on a property paid off or with a lot of equity and you're curious whether owner financing might make sense for you, my team and I here at Hero Homebuyers can walk you through your options. Sometimes the answer is yes, this is perfect. Sometimes the answer is no, you're better off selling for cash or just listing it. Either way, you at least know your options. If you've got value from this video, give it a thumbs up, subscribe to the channel, and share it with a friend, your parents, or another landlord you know who's tired of the grind. I'm Fred Pascal with Hero Homebuyers. Thanks for watching, thanks for your trust, good day, and God bless you, and may God bless America.